How do you kind of cut through, the noise, really? Because there's all these different indicators you have available to you. How do you figure out which ones to use?
So to the discussion we had before, every cycle there's some kind of different driver, right? So this time around with inflation, the rest earnings were more important than other cycles. When rates were at 0%, I mean, who cares if earnings are 5 years from now? There's no cost for interest anyways. We'll just sit and we'll wait. So that it changes based on cycle, and that's what can get confusing sometimes. Because if you look at just the past, let's say the whole COVID bull market, all the stocks that took off were just anything that had top line growth, and it was all about the new trends. And so each cycle, you need to adapt. Now, there's always every cycle going to be some stocks that are true to form. Let's say you want stocks with earnings. You'll always find a couple of stocks that lead. But if you really want to nail a market cycle, it always helps to understand what investors are focusing on. And it may not seem like it makes a lot of sense that their preferences would shift. But again, because of the economic dynamics, it does cause a shift in preferences. So that's why I think relative strength as a tool is the most important tool, because it really helps you to look at all the data that's coming in, say, okay, these are the data points we know are important. We're always trying to figure out which companies are growing sustainably, what investors are willing to pay. But at the end of the day, those that are leading in the market are the ones that are being rewarded by investors right now in this cycle.
Yeah.
So as you're looking at all these different stocks and these potential stocks, again, this is always shifting. If you can always kind of have that checklist and be like, okay, are they at least showing relative strength? If yes, it soon starts to become apparent that, hey, they're rewarding either large cap, or they're rewarding small cap, or they're rewarding high top line growth or earnings growth. So that relative strength is really the important way to kind of double check what the theme is this cycle.
Yeah. And what I like about that approach, because I couldn't agree more, but what I like about that approach is, sometimes you don't know, it's not obvious until after the fact, right? It's, so your signal is kind of like, okay, this is telling you where the money is going. Now you can kind of build a thesis as to why, but look at what's happening first, and react to that before you start coming up with the why it shouldn't or why it should, or because again, you can rationalize yourself out of anything. And I often use the point that, look, you can give me some of these headlines ahead of time and it wouldn't help me. The chart helps me, but the headline doesn't, because I would think it would do something completely different. So Matt, you kind of came up with your own little twist on relative strength. So I've got the Nvidia chart up, and this is from Caruso Insights. Explain a little bit about what we're looking at. I mean, everyone knows kind of what's happening with the price, but you have these blue shaded areas. And for people that are maybe listening to this, you might want to go to the video and kind of check this out. Again, for those listening to the archive, and you can find that at www.investors.com/podcast. Or of course you can go to the YouTube, check out Matt's thing. You can find it on our Twitter handles and everything like that. But Matt, could you explain what we're looking at here in as much detail as you can?
This came up to me when I was a market maker early in my career, and a lot of stocks I worked with were precious metal stocks. So gold stocks are interesting because gold itself is probably one of the least volatile instruments on the market, whereas gold stocks are probably one of the most volatile instruments on the market. So if you just kind of looked at any up cycle, anytime gold went up, on the way up, gold stocks will always outperform gold on a percentage basis, and on the way down, they'll always underperform. So trying to run a regular relative strength analysis never really gave me that good kind of information. So what I started to kind of do every day was say, okay, what is the typical volatility for these stocks that I'm tracking? And I'd watch them very closely. And so if gold was down on the day and the stock should, let's say, fall 3%, but only fell 1%, I say, oh, this is interesting. It should have fallen a lot more given how volatile it was. So by studying that sector and that weird spread between the stocks and the asset, it gave me that interesting insight. So I kind of took that a step further, and really it comes down to kind of studying alpha instead of just relative strength. So basically you take the stock and you look at how it's related to the index, and you also adjust it for how volatile it is, how jumpy it is. And what I do is I look at a few different time frames. I like to look at between 3 to 6 months to have a more recent reading. But the blue shaded area is basically when there's like a critical threshold is passed, where based on its relationship to the index and its volatility, is it outperforming based on its temperament? If that's the case, have a blue shaded background. If not, I don't. So if you look at Nvidia here, interestingly, you can see in January it started to turn blue background. It had a great run up. Even though we're still pretty close to the highs as of now, this bad break is kind of telling us like, hey, given Nvidia's relationship to the market and volatility, this is a bad break. So it's kind of lost that leadership role right now. Whereas a traditional ranking tool like an RS, which just looks at percentage returns over the past 12 months, Nvidia still looks great. So this is kind of an interesting tool where it adjusts for the specific nature of the individual stocks.
And so you're using kind of a comparative as what's your bogey? What is your comparison that you're using? Because you mentioned gold versus gold stocks. Are you getting that minute, or are you going broad, just S&P 500?
So by default, I found, interestingly enough, I even found that I studied the same gold stocks versus the S&P. It seems to be whoever's outperforming the S&P is really getting like the money flow. So if you want to be, if you're a really niche investor and you say, I just invest in gold stocks or in oil stocks or whatever, you can change the point of reference. You can say, I'm going to compare just to gold, but by default, I still always like to refer against the S&P 500. That's the default index everyone's watching. And that really helps to show where the big money is really rotating to.
And why do you use beta, for instance? Because there's a lot of different measures of volatility. If you want to get into the options market, you can look at implied volatility, looking forward. You can look at historical volatility, which people usually use, standard deviation. You can look at, some people like to look at the ATR, the average true range, over a certain number of periods to kind of say, oh, this is how much this stock tends to move. Why beta?
Because beta has kind of two components to it. It looks at both the volatility of the stock, but it also looks at how much it's related to the index you're comparing it to. So for example, let's say you look at a telecom company. It may have low volatility. So an ATR, average true range, or any kind of historical volatility would also kind of bring you to that conclusion. But it may not be very correlated with the index. So by kind of measuring it versus the S&P, but using both those components, you really get interesting insights. So you just brought up BCE, which is a Canadian telecom company, and they have a really high yield. I think at their lows, it was like a 9% interest rate yield, dividend yield, which sounds crazy. But I mean, they're I think probably the largest telecom in the country. So they're a sizable player with that yield. And you can see they've underperformed the entire cycle.
And before people, start saying blame Canada or, bad things about Canada, Matt is, he's in Canada right now. So it's keep your comments very, very friendly. Okay. to our Canadian neighbor. So this is a large telecom.
So large telecom, high dividend yield. This has just been completely out of favor because, with rates going up, if you can get 5% with the government, why take the risk of an individual stock? And that's what's led to this dislocation. But it's interesting. You can see that coming off of the bottom, even in this chart here, if you look at last fall, you saw there was a rally from, October into January, but the blue background never came on because the S&P was still pretty strong during that period. However, if you look at right now, coming off the bottom, we're starting to get the initial signs that, hey, we're starting to outperform here. A traditional chartist would look at this and be like, whoa, this is still in a strong downtrend, but there are signs that we're improving on a relative basis for this stock's volatility versus the S&P. So this, when going through a lot of charts, especially at turning points in the market where Nvidia has been the clear, dominant king of this market, and you're looking at this and you're saying, hey, this is fallen out, and who's falling into relative strength, and it starts to kind of, again, like we said, that figuring out for the new cycle. It seems like every 3 to 6 months there's a new kind of cycle that will take investors' attention. You help to kind of build that thesis, like you said, like, okay, well, what's driving? Is it more interest rate sensitive stocks? Is the market finally pricing in rate cuts for real again? They dialed it back earlier in the year. If that's the case, it's going to lead to new winners. This is maybe a value type of play, but again, going to even individual growth stocks, you'll start to see that, hey, wow, this is really kind of hitting new groups that weren't participating before.
Well, and to your point, sometimes that can let you know. Growth isn't being favored, value's being favored. A lot of times on our general markets page, for folks that aren't aware of this, we have our general markets indicators page, and two graphics that Bill used to really like to look at. One was basically growth versus value. He used a simple growth fund versus a value fund. When the line was going up, growth was outperforming. When the line was going down, value was outperforming. Or you could also do that with big caps versus small caps. It kind of gives you that sense, because again, at the end of the day, a relative strength really is just a ratio, right? It's just, this number over this number, which one, if it's going up, the top number is outperforming, and, opposite the other way. Talk to me a little bit about, like, especially on BCE. This seems like it had these short blips, recently, a short blip, and then, oh, not quite a short blip, not quite. Now we're in another one of these blue shaded areas. How do you know, how long is enough time to say, oh, this is really catching on now, as opposed to, oh, you had one bad day, people kind of like were scared a little bit, or a few bad days, they went defensive. How do you know it's a real trend? How many days, I guess?
Yeah, so that's why this tool looks at like both kind of 1 month readings as well as 6 month readings. So it's a blend of time frames. But another like way I like to use it as well to kind of get again, is the theme broader, or is it just one stock story? If you bring up the other chart, AMT, which is an American provider of antennas and all the other kind of telecom infrastructure, if you can start seeing it, that those kind of turns happening in other stocks in the group as well, so say, oh, I think there's a little more of a broader stock group move here than just one individual stock. So that's the nice thing, kind of being able to compare different stocks within the same group will bring also different insights as well, instead of just looking at the stock by itself.